Good afternoon and welcome to the Austin Software Cooperative June edition. We are reviewing the Radical Companies Without Bosses or Employees by Matt Perez and Adrian Perez. We are on the final portion and hopefully we get through this thing. So let's start. Let's jump right in. I'm going to do a quick review. This book, like the title says, it's about starting a company, and it's also kind of a memoir about a company that does its best to be worker owned, but also to be driven by the workers. It's kind of a challenge within the space. It's one of the challenges with starting a worker owned business and running a worker owned business is there's really three tiers. There's worker owned, which you can have workers on a slice of the shares or equally proportionate shares or what have you, but that's worker owned. And then you have worker managed, which is one step up. So you can have the managers doing the day to day, it's kind of operational. But then another step up is worker directed. So within the normal corporation, you have the board of directors, they elect the executive. That top tier, which may define strategy, a lot of where the resources are going, they really are running things. Um, that often is overlooked, and it's also a challenge. Um, you can have a worker owned business and not be worker managed. You can have a worker managed business and not be worker owned, and all of them not be worker directed. And so this book uses its own language to address all three levels. This final portion here uh, talks about their solution um, on how to do all three levels, what I'm calling with the different three levels. And they try to address some of the more difficult portions, like what everybody asks about, is like how do people get paid? How do you decide how the money's split and all that stuff? They have that previous portion and in this portion specifically about what they do. So let's go in, and I'm going to stop every now and then for questions or comments or whatever. So the author kind of has what I'm calling two ways within the book of describing things. One is a descriptive and one is a prescriptive. So saying, okay, here's how businesses currently work, and the phrase that they use is fiat. So by decree organization. So basically the boss saying, do this, do that. And then there's he describes what their company does or what other companies that he thinks the way that would be more fair. He calls that a radical company. It kind of goes between the descriptive and the prescriptive, and I'll try to tease that out as we're going. Right. So now getting into this first portion, a radical company is going to be co-owned and co-managed. Right. So we're describing like proposing making one ourselves. Right. So fiat, like I said, in a fiat organization by decree, the boss determines what alignment there is to be had directly or indirectly. In a radical organization, you and I and every other contributor will be responsible for defining all. All right, so let's close this and go right on. See over here. The basic assumption of co-ownership is that a company's value is forever changing. This is important. And they're going to describe some more later, but this is a challenge within managing a worker-owned business. As its revenue goes up and down, its value changes. Every time somebody joins or leaves, its value changes too. Customers come and customers go. Every time that happens, the value changes. And as the value changes, so will its ownership. This book, Slicing Pie, is I went through reading this and I went through and read this author has two books. I went and read both of their books, excellent books. They're gonna break it down here. So as we researched the concept of co-ownership and its related practices, we looked at slicing pie. According to Mike Moyer, it's author of Slicing Pie, the beauty of this thing is your ability to start working with someone immediately. That's meaning if you have the ability to slice what the resources are going to be, what the output of what it is when you're building this the business, if you have a fair way of doing it, you it it takes away all of these hindrances. Anybody that has started any type of venture with someone else, it's kind of like what's fair, how is the payout going to be, all this other stuff, and that's it leaves a lot open for exploitation and all this other stuff. This book actually gives a good starting point. I want to say probably the best starting point that I've seen, the Slice and Pie book, and then they modify it um, for some things on their end. So we're going to talk about that. This here, any questions so far? Because it's going to get kind of fast here. All right,
No, thanks.
all right. Moyer's clear at the start. The value of the company is not baked. It's more, as Moyer points out, trying to guess what the value of a new company is a losing proposition. We don't know what we're worth, so on and so forth. Valuations are a combination of fantasy and desperation. So, what this means, going through and I read that book, it is tremendously difficult. So, you can take two things there's static and there's dynamic. So static would be, let's say we have, and they may describe this more later, but let's say that we have a company and it's the three of us here. And we start out and we split three ways, 33%. So 33% of the shares. So there's a legal component of that. If we do say S Corp, whatever, 33% of the shares, let's say there's numerous problems that can go on when it's static like that, right? One of the things is, let's say we start a video game company and, I'm writing some software, and we have Luke on doing, some of the front end, like some of the graphics or what have you. And we have other people, working, let's say Corbin's working on like the management. Let's say um, I get 60% of the back end, the software, the coding for the game done, but the graphics and all that take a whole lot longer. And Luke's working on that. Corbin's doing the management. All right. I just say, you know what? I'm no longer interested, but I have 33% of company. I've done, 60% of work. You guys go hire someone else. I'm just gonna chill and not do any more work. You all have a lot more work to do. So let's say I work for 6 months, you all are going to work, you got 2 years more worth of work. Now, what's going to happen? I'm sitting on 33%, and you got 60% of the, like, say, back end code for the game to get done. Then you all have to do like, let's say, even more. Like, you have 70% of the work done, need to get done for the front end. Not going to be done for 2 years. Now you got a problem because, let's say the game was, let's say you get to the point where it's somewhat successful or whatever, you hire someone else, maybe you take a loan out, you try to hire someone, whatever it is, you get through, and it ended up costing like 500,000, get it all done in 2 years, 3 years. And then you're like, oh, let's start selling it. Well, I'm still 33%. And someone else you may have hired as an employee, but you took the risk and took the loan out to hire that employee for a year or two. and all that stuff. And I'm just like, well, I'm just sitting on 33%. Whatever you guys do is whatever you do. I'm still sitting on it. That is the static, trying to force a static equity, static split on a dynamic problem, right? It may be that, oh, we need to change. There needs to be way more. I presented the problem of, oh, I just want to be lazy after 6 months. I'm done. That's a problem. The other one is, um, uh, there needs to be a pivot. So now you all have to do way twice as much work as before, and I don't need to. Well, from the beginning, it should be you all need probably twice as much equity as but we couldn't figure that out in the beginning. We had to pivot. You don't know any of that. That's what this whole thing is about. Trying to guess the value of the new company is a losing proposition. And that's whether we're all maximum effort type of death march type people. You can't find out how to do the split. And then also that's if one of us is slightly shady and wants to be lazy or wants to exploit people. Either one, either way, you're gonna have an issue. Um, and it gets worse when someone comes in and says, "Okay, for your video game company, I'm gonna invest 1 million into you all, right, for 25%." That right there, now we haven't sold the game yet. Oh, someone gave us 1 million. Okay, for 25% of the company. Okay, well that means the company is worth um really $4 million. I mean, if they give us 1 million for 25%, and so now we're fighting over that or whatever is going to go on with this. That whole thing makes even it doesn't matter, dependent breaking on or depending on how much work one person has to do and all of that, who secured this 1 million, all this stuff, all of that is also a dynamic. It makes it even more difficult. Now, this is all being handled in the slicing pie and also in their solution, which is a combination of slicing pie and some other things. Does any of that make sense?
Yeah, I mean, so is does this go into like sweat equity and stuff as a
Yeah.
it's the valuation sort of prior to making the company, but it's like as you work, you can sort of see the value of what everyone's
Yes.
doing and you can tell uh, kind of ownership based off how much people are working.
Yeah. And they have an intuitive way. So Slicing Pie has a way to do that. And he has some basic, let's say, axioms to try to get you started. But they have one as well, which we talked about in the last talk, but also they're going to review over here, which is also, I think, is pretty cool. A way of trying to decide their sweat equity, which is kind of a little bit easier because it's basically you go in, you basically should just get paid what it is you get paid on the market as whatever your job title is and all that stuff. But you don't have any money yet. So it's a promise of that pay, right? And I know offhand, Slicing Pie basically says, if you're not getting paid and you're working, it's basically worth twice as much as whatever your yearly pay is. You can put it in hours, whatever. And when the company gets money like this $1 million injection, you can opt to get paid when that money gets pushed through. Everybody, gets their percentage. But the sweat equity is kind of easy. The let's say you inject money in. Okay, well, there's a solution for that as well. That's in the slicing pie. But how do you value people's ideas and some of those other things, their extra creativity that they're bringing to the table? they have an interesting way. It's basically you get judged by your peers and they can give you points. So we're going to get to that. But that part, in when we say sweat equity, it's kind of easy to do hourly. That part you can do. The part where it's like, okay, I have pretty good idea on how to increase everybody's performance and all this other stuff. The whole it's probably be a pivot for the project or whatever. I could leave and do it somewhere else with some other people because it's that good of an idea, or I could stay here and implement it. But if we're already, if it's only hourly, you really don't have the incentive to maximize. You're just basically, it's kind of like an honor system to you to be bringing your best ideas and all of that on an hourly. They have a they have a solution for that, which I thought was pretty cool. So we can get to it. But yeah, anything else?
Yeah, I've always been kind of interested in like how you figure out, um, maybe like skill levels or sort of maybe seniority of like people who've been there and have more experience and stuff. How do you account for that? You know,
Yes. So
but I,
that's a so that's it's like a normal HR pay rate problem, right? So we're normal. Like if you're a normal worker, you're normally it's your experience with getting paid is like a negotiation, and it's like, oh, you go over here. HR says, well, we've been approved to give you 80,000 a year, 100,000 a year, whatever, and you're like, well, I get paid 120 if I went over here, so you do your thing, right? But let's say if you went to a place where there's pay scales for um all jobs really. And so you can go and search that stuff and get, oh, this is what people normally get paid. So it's a range. I think maybe what you might be also hinting at is when it isn't a top down negotiation, but it's like a negotiation among peers, what does that look like? So they address that in here. But it's basically you get informed based off the market. There's scales out there and all that stuff you can use, and so that's kind of like when I say scales, that includes your experience, that includes what the title is and all that stuff like that. Does that
hmm,
sound? Does that sound?
right.
Yeah. Okay.
Yeah, no, no. Yeah, that skill difference. Yeah.
Yeah. Um. But I will also add to that they have another thing. Like if you're say, like say within software, we like to joke within software that somebody can be literally 100 times better than the next person. It's not like being on the assembly line.
10x dev.
Yeah, 10x whatever, right? Um, there's a way to compensate for that, but it doesn't start at the beginning. It's kind of in there. I know I'm gonna make. Hopefully, we make it there. But so let's go here. So what is this? The pie keeps growing. We just talked about all this. Capital infusion. So this is asking people for money. In the fiat model, capital takes over all the financial strategic decisions. That's what I was talking about with worker directed versus whoever is giving you a bunch of money directed. That's the battle. Um, let's leave this over here. This is kind of a critique of again what fiat. So normal smart person on top, they have all the money. You just do what they say. And a critique is another way to interpret this approach is that once real money makes a bet, right? So pay off. All the rest of us, all we have to do is execute according to the plan. Oh, smart person on top, they make a plan up, and we just do that. And then this just what I was talking about before. Creativity and commitment no longer are important. So all your ideas. An example I like to use is Google 20% time from, I don't know, it might be like 20 years ago now, where they're saying, hey, we're going to give 20%. Friday, you can work on whatever you want. And they're like, oh, we're going to come up with Gmail. We're going to come up with a whole bunch of other things came out of Google 20% time. And then people started realizing, you know what? I think some of the stuff I'm working on is probably worth a $6 billion product. I'm not gonna work on that and just give it to Google. I'm gonna leave, right? That kind of thing. And then Google compensated. They're like, we don't know about this 20% time anymore. People are really not, they're leaving and all this other stuff. So it ended up being like, not a great innovative. Once people get hip to what's going on, you're just giving all your creativity and commitment, and you're not really being compensated for it. That's just the stock options is not going to compensate for that. Um, the saying, well, how do you capture that? Even without the Google 20% time is made to compensate for this problem. Oh, we're the smart people. Um, we made the plan. We're gonna work on search or whatever. Rest of you just keep your heads down and whatever. They're like, you know what? People have some retired, like really smart people. They're gonna have some good ideas. Let's go ahead and do good ideas on Friday. That's their way of doing this. It doesn't work. 3M tried that before them and all that. Like Post-it notes famously was supposed to be made on this little Friday work on your own thing. And then they got rich off of it or whatever. Well, people get hip to that. And they're like, I'm gonna work. I'm just gonna just like leave when I actually have a good idea. This kind of makes it to where you build these incentives the into this co-ownership to where people want to bring their creativity and inject it into the company that they're currently in. Does that make sense?
Yeah, I mean, it's definitely I all about incentives. Like
Yeah.
you have to make people want to stay there.
Yeah. And I'm forgetting the guy that made Gmail, but I mean he got compensated, but he's not worth 3 7. But imagine how much Gmail is worth. It's worth more than 7 6 7 billion dollars. Right? He's not that. He's not a billionaire. So and some of the other things too. So uh people get that and they're like, you know, I'm not gonna do this unless I'm really, I have some better. The equity moves around and changes. It's dynamic. Um, yeah, we already basically talked about this. All right, let's go over here. Radical compensation. So this is gonna address some of the things. So salary, they give some examples of people who are basically setting their own salaries and all this stuff like that. So self-set salaries. Let's read this. The first time I heard about self-set salaries was in 2007, reading this book, Maverick, which is also a really good book. So currently, several companies are using various forms of decentralized salaries, including, and this is a big list, right? So Nearsoft is the name of the author's company. They said that they got stuck in the fiat way, so the decree way, old way of assigning salaries, and have not made any serious experiments to change this at the time, right? So apparently, um, yeah. So he's giving you some examples. But let's go over here. Oh no, here we go.
I have not heard of self-set salaries before.
Yeah. So basically, I think they're about to. I think they're about to talk about it here. But basically, okay, yeah, let's start that. In the radical case, once we're ready to invite someone to join, so let's say that someone's like kind of on a probationary period, they're hanging out with you for 6 months, whatever. Let them figure out a salary that works for them and the company. And already, they've already been working. They're a de facto member, and with the help of the other members, she can identify people who are the most like her. These people can even suggest others who would be even more akin to her in skills, experience, and other. And then she could then get together with her peers and figure out a starting salary for her. So it's kind of like getting around people who are doing some of the same things you're doing, all that stuff. Their companies, I want to say they're more than 50 people, 50 to 100 people in Nearsoft. So they're able to do stuff like that. You're just smaller, you're gonna have to go off of pay scales and stuff like that. But it's really like take a radical if you want to see a bunch of um use cases. Unions set salaries. First thing that happens with a union when they win against and they form a union and they go to the negotiation, for one of the first things they do when it's a legit one and not a fake one, there's a lot of fake ones. One first thing they do is they make pay scales, and they actually make all of the pay really rigid and documented, let's say. And it's like, whoa, that seems kind of weird. Like, okay, the workers are gonna set all the pay. Don't they fight and all that? When they do that, they have much better capability of negotiating and negotiating raises. So within unions that are functional, as far as when it comes to pay, one of the things people complain about, like say the unions at Ford or something like that, is they're getting paid too much. They're getting paid, $75 an hour for doing nothing. Like, well, it must be effective then. Like they basically the pay scales uh actually work in those negotiation type things. So they're able to do it, and you can that it's kind of well documented. You can kind of and we've reviewed a couple of books on some of that bargaining and organizing. Um, so you can kind of see how people do that. So no, it's possible just from the union use case. When people get together and talk about pay and go and look at um, competing, pay scales, you have all the same issues in a top down negotiation, right? But it's a bit easier, right? So top down negotiation, someone you don't really know, and they're trying to get you to be there for the least amount of money or whatever they're trying to do, right? When it's people that you've elected to work with these other people, they're kind of your friends or whatever, and you're starting something that's co-working, it's much easier to point over at, hey, they're getting paid this. And then someone could be, you kind of know, like, yeah, I'm the best programmer on the planet. And your friends are like, man, come on. That kind of thing. And it kind of problems kind of solves itself. If people don't get paid what they're worth, they're just gonna leave. Right. So it's not as big of an issue as you would think. And if it is an issue, you learn because people will just leave. So yeah.
I would think if you're really aligned with the company itself, then you would you would not just be making a salary that works for you, but also the company. I
Yeah,
mean,
yeah,
it's about aligning those incentives, right?
yeah, yeah. And so again, we're in this mode of I need to get salary, and the equity thing is a question mark. We're gonna get to a portion where it's kind of like, oh, it's gonna make the salary thing a little less easier to deal with here in a bit. Because there's other compensation that seems a lot more fair. Um, I'm going to read through this. So when you really think about it, salary is a fiat tool. This predictable reoccurring income is what he's calling it. Employees get income predictability in exchange for obedience. Follow orders and get a paycheck. Salaries, such as they are today, do not quite fit in the radical context. In fact, the subject first came up when we were writing this book and thought messing with salaries was wrongheaded. So this predictable reoccurring income, he's got a whole way of dealing with this. And you have situations where somebody could they go on sabbatical, they have a medical issue, they have to leave. Um, and that's the what about compensating somebody when they have something that's an agreed upon hardship that you want to continue. How do you deal with all of that stuff? He's got a little plan in here. It's kind of more theoretical. This is what the kind of idea that I got from it. But basically, he goes through here. Actually, I won't read all this, but you kind of get the idea that there's an issue with there's the company has bills. One of those bills is predictable reoccurring income. Obviously, if the company is making some type of profit that's going into another account, that for a rainy day fund kind of thing, okay, you're gonna pay people from that when they have hardships, that kind of thing. Yeah, and it's transparent. Let's coming back. I want to get to this portion. The splitting the atom is the author really trying to address how difficult it is to get people to believe that you can have a co-owned and co-managed business. It's just super difficult to get people to believe in that, because it just people just believe in a hierarchical fashion for solution for everything. So talking about separating power from capital, he goes into that, and so I'm trying to go over some of the solutions that they have. So again, I'm going to take a step back. One of the fundamental problems with uh, a worker-owned business, where it's a unique kind, is a worker-owned where it's one person, one vote. Let's say is attracting capital, attracting investment. How do you do that? Normally with a regular structure, corporate structure, you give away ownership, some portions we call it equity. You give that away for the money, and you can give away a small amount, like 25%. You may think, oh well, we still own everything. Like no, like you don't. Like when they give you that money, it comes with a bunch of contracts where they're the first um privileged uh uh creditor kind of thing, and you may have to put a lien on the whole business to them and all this kind of stuff. And you hear people talking, hey, we just got this 10 million $100 million investment, and we only we gave 5% or whatever it is. They put a lien on the business, and those people, they own the business. um so all of that stuff, like they can go in the bank account and take the money out, that kind of all this power. So you have to, my point being, they're giving away power for money. And so how do you, if you're really saying the workers should, again, manage and direct the business, it it is, antithetical to giving away any of the power. So like I say, in a cooperative, it's one worker, one vote, and it's very strict. Like literally, no one else to really be using the term cooperative and all that. There's no one who's not a worker who can vote and who has any voting power. But other worker owned, worker managed, directed, that kind of thing, you can have some leeway. Then the way the radical companies, they try to solve that with this type of point system that we're going to get into. Um, so he's trying to address that. So I'll go back into here. Rather than power, as an investor in a radical company, you get a predictable financial return, right? And this does not prevent you from contributing to the company in other ways, becoming a co-owner of it and earning a voice. So this predictability, he's trying to say, it's like a strong promise, something like that, to where okay, you're going to get it back. Where no, but it's probably, well, he doesn't have anything in here where they're saying, oh, we're putting a lien on the business, we're doing all this other collateral stuff, and all of that, or even giving you any shares. Like there's no shares given out. Let's let's leave that alone. This again to go back, the splitting of the atom. He's talking about okay, normally the way problems get solved in a normal corporate structure, the people that have invested a whole bunch, whether it be, I mean, you may have a, it may be the founders have a bunch of money and they're the ones that it's a top down hierarchy that way. Or you may have, you had a great idea and all that, and investors came in and then you exchange power for that. And they want you to sell them every month, every quarter, or whatever it is on why they shouldn't like take all the money away that they gave to you, you know, all this stuff like that. Um, and so this thing of who is it that has the best, who the the best ideas and who's in the best position to direct the company. And when we normally think about it, we think what he calls the fiat model. The investors are the ones who, you know, it's like dad knows best kind of situation. And he's trying to fight against that. So here, in reality, when a company is heading off the rails, so everything's getting screwed up, the people who show up to work every day will know about it well before traditional board even hears about it. So again, he's arguing against power should be with the people who are investing. This is one argument against. As far as saying, oh, okay, I'll take a step back. Oftentimes people will say traditional hierarchical structures, the they're more pragmatic. They work better. Forget about fairness, all of that stuff, right? Forget about exploitation, all that. Just they work better, right? And he's this is an argument against the pragmatism argument, saying for hierarchy. He's saying no, they don't work better in this situation. So seeing what's wrong, the people who are on the front line see first, so they can address it. Um, yeah. So we're gonna get into how they contribute. Let's see here. Um, yeah, and he's going in here trying to give examples of hierarchy. Traditionally, people had a strong belief in a king. Of course, you have the United States, and they're like, we're not doing the king thing here. And then people are like, it's not going to work. And it's like, oh, look, lo and behold, it works. Decentralizing power a bit works a bit. French Revolution, they went back to Napoleon afterwards. So people will point to that, say, oh, well, they failed. You know, they're going back and forth over there. Um, you know, here's some questions, right? What they, you know, you all may be thinking, and you know, I think about now and then, where would employees get their direction from? Are they going to figure this out by themselves? When will they have the time to do the real work? How else would you make sure that the employees are working hard to make the owner wealthier? Right. So these types of questions, people just constantly, and even right after you answer these questions, people are just going to ask them again. It's really, really hard. Right. Um, this is kind of how the hierarchical system keeps really reproducing itself. If you spent your entire life playing this massive multiplayer game called bureaucracy and learning how to accumulate and use bureaucratic power, when someone tells you, now I'm going to change the game, it's like saying to someone like LeBron James, a basketball player, that now we're going to be playing volleyball. Probably not going to be enthusiastic about that. That's how difficult it is, why he's calling it splitting the atom. It's really difficult to get people to think differently. Um, so he's going through here again. There's no command and control structure. I'm going to try to get over to leave that alone. So I'm going to stop here. Is there any questions so far?
No, but it's all making sense.
Yeah. So retain earnings and internal capital investment. This is a thing that comes up with any form of worker owned business. Um, there's this idea normally, you have some type of profit. You have something that goes over and above paying everybody and all this stuff like that. What do you do with it? There's this idea of internal capital accounts that you can have in the bank. And okay, fine, you open up another account in the bank, you put some money in there. They're kind of, you can have internal capital accounts that are assigned to individuals, right? That they can't really touch, they can borrow against. It may be for rainy days for them and all that. You have internal capital accounts that are for the whole business. These are things that you will go ahead and use for projects that you all voted on or however you decide um, to work on. And then those come from that. So it's a way to save the money and try to wrestle with the whole idea of, oh, how are we going to get funding? How are you going to negotiate with banks to say, well, we want a loan to do this initiative. We're profitable. We've been making money over every month. Give us some money, right? And they're like, really? Well, why should we? It's like, well, we have these internal capital accounts that our people can't touch, except for in these situations. We're going to use that for capital. As far as we're going to use that for collateral, I mean, when we get this loan, like that's another use of these. Um, so yeah, retained earnings. So that's the explanation for all of this stuff. So given what I just said, very simplified, there is a book called Open Book Management. Okay. And this book, right, it means the best interest for the company to have co-owners learn how to read the books. So accounting books, open book management. This is a back and forth. So how much does each worker have to learn or should learn in order for you to be effective, right? So somebody just wants to know about software, someone just wants to know about marketing, right? Consulting. Why do I need to learn about anything else, right? This book and this kind of movement makes the argument that it's not prohibitively difficult for everyone to learn how to read the books. That's what open book management. Now, this open book doesn't mean everyone makes decisions, right? That can be in a co-working, co-management, directed and all this. But just having the books be open is a controversial thing. But this movement and this book highlights all the success stories of doing it and the benefits of doing it. Um, so that's also part of the budget, so people can know about, you know, what resources where we're gonna put what resources and what projects we're gonna fund. And here's the saying: um, people are just gonna be scared of going away from the hierarchy. Any questions so far? So we're gonna try to get over here to this investment capital. I think this is gonna be, these two are gonna be.
I was thinking that that kind of tied back to the setting your own salary. That the open books seems important to that.
Yeah, I mean, you see the salary, everybody's seeing each other's salary. Everybody always says that it's just awkward. Everybody's seeing each other's salary. I used to be in the Marine Corps. Everybody knew what everybody were was getting paid, right? Like it's done all over the place. Everybody, it's not a very difficult thing to do. Um, and it's not going to be like everybody's at each other's throat immediately. I will say the opposite. It works against you when you don't know, when you're in a hierarchical. um company structure. It's like, I don't know, and especially in the United States, like we it's kind of taboo to talk about pay and all this other stuff with whoever you're working with. And you're like, okay, is that for us? Or, are the people on high, the smart person that's, control is are they're saying, oh, you all shouldn't know when anyone else gets paid because you all just start fighting, like kids. And we can't have that, so let's all of you, don't talk about what you get paid and all that. Is it really for you, or do you think it's for them? It's for them. It's for the hierarchy. It's not for you, right? You When you see someone else get promoted, that's a thing to fight about. There's all types of things that make inequality in the workplace, and you figure out how to not fight with each other. You still can get jealous or not jealous or whatever. The pay is another one. But no, negotiation wise, if you all know what everyone gets paid, it becomes more fair. And use the productivity, we could say productivity for the past, even it's 2025. It's like going back to early 80s, 70s. Compensation productivity has gone way up, and compensation has flatlined given um inflation. So we've all been doing better, and we've not been getting paid more. But of course, executive hierarchy, things, people in the top of the hierarchy have gone from the late 60s and 70s, from like 50 to 1, and 25 to 1, 51, all this stuff, to 350 to 1, right? And that's because nobody knows, one of the techniques is people don't get together and jointly negotiate for pay. Nobody knows that everyone's getting, not getting compensated for the higher productivity gains that they're happening. That are happening. Um, yeah. So let's go into this. Let's go close this one. Let's go over to liquidity. Um, yeah, this kind of goes into what I was talking about before with the whole internal account, ESOP account, holds wealth. Can you go in there and get a loan against some money that's in your own company? These types of things. So now we're gonna start talking about this RADs. So I believe he goes over it in a second, but this is their way of doing a distribution, a mini distribution, not the whole thing. You still get your predictable, what do you call the predictable compensation every month, but there's another component. And let's see here. Find a need for this. So basically, again, against those internal accounts, you can get compensated. Actually, I was surprised to see this. This is a government contractor site, and they actually had something where they were doing some internal accounts for their employees. I was very surprised to see that. But let's go. All right. Here we go. I'm going to talk about the rats thing. So in the previous the previous portion two, they talk about rats. So I'm wanting to, let me go up. Let me go back up here for a second. Nope, not that one. Let's go to the slicing pod thing. I want to make sure he didn't go. I didn't miss something. Okay. I think it's later. All right. When I miss it. But I'm going to explain it at this point here. So there is in this um a thing called, I want to think it's called a Rothdale. I want to say a Rothdale distribution. So the way it works, they base their radical points off of this uh, Rothdale distribution method. So what's that? Basically based on this method where you get, let's say your compensation is something like 8,000 a month normally, right? So you get 8,000 a month pay a month. Well, everyone takes like 20% off of that, whatever, 10, 20%. Let's just say you don't get paid, but no, let's make it even. Everyone, the example would be they take $1,000 off of their pay, right? And so, given that, let's say we're making video games, we already have some sales coming in and all that stuff like that, and everybody's getting paid normally, right? So, what this Rochdale, there's a certain amount of profit that is being going into the company already. What do you do with it? Okay. So you can maybe take a little bit off of what everyone's getting paid, or you can just go off of the just profit. Everyone just gets paid whatever they get paid. But this distribution, which you can do without making any money, and you can do it before you're profitable. Everyone gets, for instance, 1,000 points every month, and they distribute those 1,000 points, but they can't distribute it to themselves. They have to give it to other people in the company who they think are benefiting the company. The only restrictions are you have to say what your criteria is for distributing the stuff. Like, here's my criteria. I value people who are just nice to people. I don't know. Or I value people who have great ideas, or I value effort that hard work when somebody stays extra, whatever. You put your criteria. And anyone can ask you what your criteria is. Those are two in the radical company um method conditions. But you give the points out, right? Um that's the Rothdale, I believe, distribution. And so now you have everyone in the company. Remember, he said the people in the company, they know things that are going wrong. They also know things that are going right. The argument is people that are lower in the hierarchy, and there's no hierarchy in this setup, they actually know. And so what you're doing is you're giving them the ability to distribute these points. Well, what happens with the points? Whenever you distribute money, it has to go proportionately to the points. You can do other things like decision making or whatever, but it's more like the money side. It's the money, the points, what he calls rads. They are representative of like ownership in the company. And so he's going to be talking about that here, right? So why is that useful? So remember, we're talking about, hey, what about people who are that employees that don't participate anymore? They left, they got a certain amount of shares or whatever, and they left, right? How do you compensate that? How do you deal with that? In our situation, you know, three of us start the software company, game company, and you know, it could be that we're all doing well in the beginning. We're giving each other these 1,000 distribution. We're doing it evenly. Maybe Luke's a rock star, and we're just like, yo, I'm giving all of my stuff to him. We both meet Corbin, and we just giving Luke all the stuff because he's really holding it down, right? But we can't give it ourselves, and it goes forward. I had a certain amount, but when I leave, every month it's dynamic. You continue to give more and more points on the month per month. So if someone leaves, they had a certain amount, but it's decreasing. Their ownership is decreasing. So you have these absentee owners, let's call it. That's a big problem. Is how do you deal with absentee owners? Slicing pie has a way of doing it, and the RADS naturally handles that, right? So let's say if somebody walked on water for 6 months and everybody was like, hey, they're doing all this stuff. When they leave, it's like, hey, at this point in time, do we have money? They get compensated instantly. There may be some a certain amount that they're owed or whatever. But as the company goes forward, they walked on water for 6 months, but we're not profitable for 5 years. It's going to be diluted. Like, how much work did we have to do to get to that point, right? So that's what the RADS is about, right? Um, it's that, remember, static equity versus dynamic equity, right? So that's what he's saying here. Let's close this. Beyond providing liquidity for individuals, we may need to provide investment capital for big company projects. Some of it might come from return earnings. We can save up for it, or we can come up with a rad leasing scheme that would work for capital investors, or we could borrow from a radical bank, right? So he said revenue, time, and even honorifics could easily be factored through RADs. I just explained what that was. What about building a fleet of trucks? In a fiat business, the owner owns the asset. Since ownership is decentralized and dynamic in a radical company, how would it work? Who paid for the building? Who gains from it? 1 month, I may end up with 10% of all the RADs in 6 months. Later, maybe 3%. If I bought the building with 10%, does that mean I own 6 months later? I only own 3% of it. One way to handle this is have the building own itself, right? So trying to work through all these things of who owns assets and things like that. So you can deal the way you can deal with that is the company owns leases the the assets. Like a radical company could lease RADs yield to a capital investor. For example, imagine a small company that needs 200,000 to buy cloud services to get more paying companies customers. To do this, its co-owners would agree, for example, to have the company retain a percentage of RADs to lease to an investor. The investor puts the money up front in exchange for rights to the RADs yield, and the company uses the money to get the cloud services it needs. It gets more paying customers and redeems the RADs and pays the terms of the agreement. So that's this whole asset problem. RAD leasing, so you can do that. Or was it saying RAD investment? A radical investment is much like an investment from a VC. The company gets a cash infusion to create new products, expand into new markets. The significant difference is that a radical investment is purely financial, right? So no, what we were talking about before with the ownership, it's basically like getting a loan, doing a lease, and all that. And then he talks about having a radical bank. Right. And we already talked about the inactive members, right? But I'm going to go through. Inactive members get to keep the RADs. However, the number of RADs will increase over time, and the inactive members, RADs will become smaller percentages of the total RADs. They will continue to get dividends as a factor of the RADs, but as a percentage, they will get less and less over time, right? So, for example, imagine when our member Anita goes inactive, she has 1,000 RADs, or 1% of the 100,000 RADs allocated so far. If we generate 100,000 in dividends, she gets $1,000. At the bottom left of the graph, I didn't put the graph in here. Later, the number of allocated RADs grows to 150,000 total. The dividends to 120. Our inactive member still has 1,000 RADs, or what is now point zero, yeah, 0.67% of the total, and she gets $800 later. Still, she's gonna end up getting $500. So that's how you deal with the absentee owners problem, which is a big problem with traditional ownership. This is a way for dealing with that um within that's actually better than traditional ownership. Um you can't sell the RADs. They represent your voice in matters of governance and they cannot be sold, that kind of thing. All right. And that I think this and that's basically it. Any questions? We are at 8:12, so we're at right at the end.
Cool. Well, what that last part? Well, what prevents them from being sold?
That's the rule. It's like you could put it in the bylaws or whatever like that. But
I guess what's behind that? Was that just kind of preserving the integrity of like the ownership? Um,
yeah, so there's a bunch of different things with worker owned businesses. So there are legal structures that are called cooperatives, and there are legal structures of partnership. There's limited liability partnerships. There's S corps, C corps, stuff like that. So all of them have different ownership structures. The part that static thing and versus dynamic, that's where the trouble runs comes in. So there are ways to set up these structures, really any of them. You get a lawyer to set it up. So where you put in the bylaws when you create the entity, you put the in the bylaws all the rules that you want to have, and then the people don't actually own any shares, and then you could go off of a different setup. Now the taxes might be messed up, so that's where you need to have uh, the accountant in order to set up the taxes properly, where everyone isn't getting into big trouble there. But as far as distributing, let's just say you're not caring about tax so much. As far as doing the distribution, if the bylaws are a certain way, and then somebody says, you know, a coalition gets together and says, we're going to violate the bylaws, we're going to violate all this stuff like that. The force behind it is that an employee could sue, right? They could say, you know, you all said you work this way and you're not working this way, and it's going against the profitability of the business. So you have a leg to stand on. And you can also do contracts. So you can have an employee contract where in the contract you say this is how we do our distributions, all that. So you make the entity also exposed to legal that way as well. If you want to have force behind it, right? Does that answer?
right. Yeah.
I mean, you
No,
could do
this
the honor system, but you could also do these other things. The slicing pie guy deals with this as well, where it's like he has this grunt fund, he calls it, and it's basically a big honor system, but it's so different when going back to the open books when everyone can see, then it's a different game. As far as people getting ripped off and all that, it's a totally different game.
yeah.
So even if you go by pure honor and really you set up the entity to where one person is the literally the legal owner, but you set up this slicing pie setup, uh you could everybody is a part of it. You only get one chance to rip everybody off, and everyone's going to know in your community that you're just a bad actor. He gives examples in that slicing pie book of that, so he kind of goes off of that style. But you could lock it down even more with contracts if you want. He kind of recommends against that because he says um, it's very burdensome, and but he says this burdensome thing, but it um the trust factor. He said basically when the more contracts you have, the more trust is not needed, and it ends up working against you. He has some type of argument there. You could do it or not do it. He said they have great experience with starting, and we're talking about companies that have no money. They're starting with 2 people, 3 people, do the slicing pie thing, and maybe the somebody's putting their own second mortgage loan money in, that kind of thing. And it's because the way he's saying to do it, this with the slicing pie, caring about fairness and all that, is a lot more fair. You have better results, right? Because static is broken and dynamic is better. You take this mode, you have where it's not only you're caring about this fairness and slicing the pie up in a fair way, but you're also doing it where you're promoting worker owned, worker managed. That's layered on top using this RAD system, it will be even better. And this system is pretty simple, this rat thing. So if you add both, you put them both together, I think it's pretty good.
Yeah, I was also wondering about the idea in the RAD system where you have to be able to answer why you gave like what you're valuing in giving your points.
Yeah.
And um, yeah, I guess I was sort of thinking like while you were describing that, like could two people sort of collude, give each other their points, right? Like what is human nature going to
Yeah.
do in a
100%.
system like that? And
Yeah.
maybe, is that to prevent to say, okay, well, why did you give all your points to this person and y'all just swapped points. You have to answer for that and justify why.
Yeah. I mean, earlier they talked about it in the previous portion, but it's like the whole open books thing. When you have people viewing, it changes the dynamics of human behavior. So it's like you can try to calculate everything out to fairness, or you can allow the people to decide. And then, so if you got two people, you're giving each other the rats or whatever, right? You got two people like, hey, I always give you mine. And the other person's like, oh, I always give you mine. And it's like, well, the third person is like, well, I have to give them to someone, and I see that you guys are acting up. I'm just gonna leave because I think you're not being fair,
Yeah.
right? It's not gonna work. Like you're not gonna be able to. And given how people are so, concerned about what other people are doing, anyways. Like it's funny how these discussions. It's like, well, we can't know what everyone gets paid because then, you know, everything will be weird and people will be jealous. And then it's like, well, what about if people collude? Well, we just made the arguments that people don't like, they're super jealous. So guess what? You start colluding, they're gonna know, right? Everyone's gonna see you. You're gonna be scared to collude, right? It's like, oh, those three over there, they're always giving each other stuff. Okay, well, those three are acting up or whatever. We're probably not gonna give them anything. You know who I am gonna give something? That person got brought in, let's say we're a law firm or something, and we only make like 1 million a year, and it's like five of us, right? And a new person comes in and they bring in a $5 million trial. Oh, I'm yes, that person was walking water. I'm giving them. I'm giving them. There's someone who brings in new work. I'm gonna give them my rads or whatever, right? And it's like, and these other people over there, let's say these other people over there colluding and doing whatever. And I'm like, you know what? I'm just gonna keep giving this guy uh my stuff, and it's gonna naturally fix itself. Or me and him might just leave. You guys are not. You're exposing yourself. Whereas before, it's difficult to expose yourself when everything is behind the scenes, right? There's a bureaucracy, like we was talking before, and there isn't any public recognition of effort, performance, or something. No accounting of it. The bureaucracy and the power games and the silos and all this stuff runs wild.
It's
So
almost like a peer pressure to do the right thing, I guess.
yeah, peer pressure, humiliation. It's almost like an intelligence. It's like an IQ test.
Hmm.
Like, oh yeah, I'm just gonna collude right in front of the rest of you. Really? Okay. How well that works. So
I think
um
with the collusion, I mean, if you only have two people, I think especially if you have like a larger company, like two people just don't have that much power.
yeah,
So like I mean, I'd argue in on the other end where you have a traditional big corporation, like there's absurd collusion going on there all the time with the C-suite and board of directors and upper management all agreeing to pay each other a bunch of money,
yeah,
and they just hide it and so they can get away with it. Whereas it's like, yeah, so you might have collusion, but you're going to have way less of it, just inherently because they don't have the power to, like, to give all their money to themselves. They they only have the power to give away, the however many rads they get a month or whatever.
Yeah. Yeah. Imagine explaining yourself and your your criteria for giving away every month with all the books open. You know, it's like, imagine you're at Apple, Steve Jobs still around and all that. And it's like, Steve Jobs, like, yeah, you know what? I really got to I forget the guy's name. I really got to give this guy over here all my rats because he decided how to outsource all our stuff to Foxconn, 2 million people in Taiwan or in China, wherever. Right. And yeah. So we got slave labor going on over there. And that makes us a lot of money. So I'm going to do that over there. Okay. Everyone else is a worker. It's like, I don't know. I think I want to give my rats to the person who did the latest version of the MacBook Pro or whatever. I like that guy more. I don't like the guy that outsources. Oh, he gave a bunch of money. Yeah, I just something sits wrong with me about that. Right. And then you, Steve Jobs. Oh, that's what you value. Oh, okay. Right. But right now, you don't know that. All you know is the writing. You just know some guy that walked on water came and said, you know what, we need to put this stuff over there. We got to make these iPhones only cost like $1,000 instead of 15, 5,000 or whatever. You could see what people value. You could use what I'm saying as an argument against. You could say, well, nobody's gonna do the exploitation and really lower those prices. Right? You may. That's what going back to the splitting atoms portion. Uh, the whole system needs exploitation. It goes back to that. It's like it doesn't. You could do things without doing that. You could be profitable without doing that. All that stuff like that. Be real interesting to see what everyone values, and and it would at that level of expectation still happen, probably not. And I just imagine C-suite executives, all that, every month having to come up with some new fangled, while the books are open, way of saying, yeah, this other person brings a whole bunch to the table. They were able to do all these new financial instruments, do some convertible bond, whatever, all this stuff like that, and make all this money for us. That's why I'm giving them mine. Okay, you did that this year, this month. I want to hear it again next month and the next month and the next month, some new thing. It's not, I don't think it's going to work. It'd be interesting to see, you know.
Yeah. I had another question about the RADS
Mhm.
method too. Um, and that is if you bring more people um, into a company, is each person getting like the same amount of RADs? Like is the
Yeah,
total number of RADs being issued like growing with the company, or is it like
yeah,
we're only
yeah.
issuing a set number of RADs, and if we grow, then less people have RADs to issue?
I think everyone has the same amount.
Okay.
Every individual has the same amount.
Got it.
So you hire somebody. There's a whole section in the book where it's like when you hire someone, it's important. It isn't. It's a little. It's with a worker owned, worker managed, and all that. It's a lot more impactful than hierarchy style business because they're going to have the ability to make decisions and vote and all this. So
Yeah, I could certainly make the inactive members sort of like ownership decrease fast if the company was growing fast.
yeah, 100%. If the company is growing fast, but remember, you get the percentages changing even when you're not growing. Like every month, you're
Yeah.
distributing more and more. So, that whole thing. Yeah, and you could play with this. You could basically say, okay, if you haven't been around for a month, or sorry, if you haven't been around for 5 years, you're effectively, and we didn't make any money because the distribution, when you distribute, it needs to be based off of whatever the ownership structure was, ownership in quotes, like this rad thing. And so, if over 5 years, you've been gone that long and you didn't get any money, you're not going to get any money. Um, if you do it and you could make it to where it's 10 years. You could make it to where it's 1 year or something like that. And people will know, hey, oh, we're doing this rad distribution thing and we're not making any money right now, more than what my pay is, then it's just a paycheck, that kind of thing. And so it's not gonna be that important because yeah, you guys may not make any money after a year after I'm gone, so it's not gonna be that much of incentive. But when it's like, oh, if it's over 5 years, well, that seems fair or what have you, that kind of thing. Um, you know, and then you work on projects and no one ever it never makes any money at all. It happens all the time. And it's like, yeah, well, you're not getting compensated. So um that I think it really shines when you're not getting any pay, and it's to incentivize you you get paid 5 years from now, but you're not getting any paid now. Then this rad thing is the alternative to the shares, right? And it incentivizes you to uh continue to be around and help and all that for the however long. And you're like, I don't want to do this anymore. You still have a runway of where you could get a payout, and your risk isn't nothing. But the other one is, oh, I have, like I said, 33% of the shares. Now you have the opposite issue where people are literally incentivized to leave, and uh if there's any money made, then they'll get 33%, right? So it makes it more dynamic. The whole idea of it being dynamic is you can play with this and make it to where how long runway you want, you could put in there so you can make it more fair. I think that's it. I mean,